Consider this the definitive guide for how to get started with investing. Before we begin, please like this video and hit the subscribe button with notifications turned on so you will be first to know about new content. Our mission at the Personal Finance and Investing channel is to empower people to achieve financial independence. Subscribing will help us achieve that goal. Now, let's get back to today's video. We'll start by outlining some key principles of investing. First, what is the difference between saving and investing? Saving is when you put money aside for future use. Let's say you want to buy a car or house in the future. You would likely save money to pay for those things. People typically put their savings in bank accounts which are insured up to $250,000 by the Federal Deposit Insurance Corporation or FDIC. This means that if your bank goes belly up, the FDIC will reimburse you up to $250,000. In short, a savings account is perfectly safe and there is virtually no risk to it, but you also won't make much money on it. Investing, on the other hand, is when you put your money to work for you. You exchange your cash for some asset, whether it be a stock, bond, shares of a mutual fund, cryptocurrency, real estate asset, etc. There is some risk to investing in that you could lose all or part of your money. However, you also get the reward of the asset appreciating in value or generating cash flow to compensate for the risk you are taking with the investment. One way to think about the basic difference is that savings is risk-free, but you won't make much money. Investing involves risk but with the reward of potentially much higher returns. Consider this scenario. Jane wants to save money for the future and puts $3,000 per year into a savings account every year from 2000 to 2020. The savings account averages 1% return. She could access her money at any time and it was safe. After 2020, Jane had $67,083 in her savings account. Anna, on the other hand, wanted to invest for retirement. She invested $3,000 per year from 2000 to 2020 in a moderate mutual fund which returned on average 6% over the 20 years. Note that it did not return exactly 6% each year but averaged 6% per year over the entire 20 years. At the end of 2020, Bethany had $140,407 in her account. Note that each person contributed the same amount of money. They each put in $60,000 into their accounts. Jane ended up with a profit of $7,083 after 20 years. Anna profited $80,407. In these scenarios, who wouldn't want to be Anna? Dollar cost averaging. This is a key practice of investing a fixed dollar amount on a regular basis, for example each month, regardless of the share price. This is a great way to develop the disciplined habit of investing automatically rather than trying to save up and make a big investment later. There are several benefits of dollar cost averaging. First, it is easier. Investors can set up their accounts so that investments are automatically made every month on a specific date for a specific amount. This makes it easier for investors so they don't have to remember to manually make the investment and so they don't have to try to save money for a long time to make a bigger investment. There is a greater chance of success that a person will actually make the investment. Second, buying consistently takes advantage of buying more shares when the share price is lower. This means that over time, an investor can end up with more shares for a given investment amount. Consider the same scenario of Jane and Anna. Jane decides to invest in a stock and will save $100 in her savings account each month for a year and invest all $1,200 into the stock at the end of the year. Anna, on the other hand, invests $100 each month on the first of the month. At the end of the year, she too will have invested $1,200 in the stock. Let's assume that hypothetically the stock price meandered from a starting price of $20 in January and goes down to $10 the next month, up to $30 2 months later, and so on and so forth before settling down at $20 for the last 2 months of the year. In short, by the end of the year it ends up at the exact same point as it started. While most would not consider this to be a great investment, it is illustrative to highlight the benefits of dollar cost averaging. In this scenario, Jane would own 60 shares of the stock worth exactly $1,200 at the end of the year when she made her purchase. Anna, on the other hand, was able to acquire more shares when the stock price dropped down, so by the end of the year she owns 72 shares of the stock. She invested the exact same amount as Anna, but now her investment of $1,200 is worth $1,433.33. Dollar cost averaging is both easier for the investor and leads to more shares by buying on the dip as the asset's price changes over time. Time value of money, aka early beats often. Let's compare another scenario where Jane and Anna are both investors in a mutual fund that returns 6% each year. However, they invest at different times of their lives. Jane waits until she is 41 to invest. At that age, she starts investing $2,000 per year for 10 years. She has thus invested $20,000. By the time she is 50, her account has a value of $27,943 or a gain of $7,943. Not bad. Anna, on the other hand, invests $10,000 when she is 31 and lets the money grow for 20 years. When she is 50 years old, her account has grown to $32,071. At this point, her account value is only a little larger than Jane's, but remember, she only invested half as much. Anna's account has grown by $22,071. She has profited almost 3 times as much despite investing half. How is that possible? It's the time value of money. Jane had an extra 10 years to let her account grow. The benefit of time leads into the next concept. Compound interest. Albert Einstein said, "Compound interest is the eighth natural wonder of the world and the most powerful thing I have ever encountered." Let's put that to the test and see if he is right. Compound interest is the interest on an investment based on both the initial principal and the accumulated interest from previous periods. For example, let's say Jane invested $1,000 at 20 years old in a mutual fund that returned exactly 6% each year. A year later, she would have $1,060 or a gain of $60. At the end of year 2, she would have $1,124. The year 2 gain was $64 because in the second year she was making interest not only on the initial investment of $1,000 but also the small amount of interest she had gained in year 1. At the end of year 3 she would have $1,191, or a third-year gain of $67. Her gain in each year increases. After 10 years, her account would be worth $1,791. Her investment would have doubled in the 12th year. After 20 years, it will be worth $3,207. Her money has tripled in the 19th year, quadrupled in the 24th year, and quintupled in the 28th year. After 30 years it will be worth $5,743. If we assume that she retires at age 65, 45 years after she made the initial investment, her account will be worth $13,765. Her money has returned almost 14 times her initial investment for doing absolutely nothing. Remember that in this scenario, Anna only made a single investment, whereas most people will be investing over the course of their entire lives. Furthermore, this scenario assumes a 6% return. Over its life, the S&P 500 has returned an average annualized return of 11.88% from inception in 1957 through the end of 2021. It is also important to note that past returns are not a guarantee of future results, as the S&P 500 has declined by almost 24% in the first 9 months of 2022. Then again, these declines could present buying opportunities from an oversold market. To summarize the key points thus far, we suggest some basic principles of investing. 1. Invest as early in your life as possible. 2. Invest automatically on a consistent basis. For example, invest a fixed amount of money automatically on a given day of the month. Set it and forget it. Let the investments run and watch your account grow over time. So how do you actually start investing? There are a few simple steps. First, pick the platform. There are many easy places to start investing. You can open an account with any number of platforms that all have plenty of options to invest in. We suggest that you go with a reputable platform. Consider Googling best brokers for beginners, and find an article from a company like NerdWallet that evaluates financial products with reviews. We will create a dedicated video in the future about the top brokerage firms for beginners. Examples of some of the top platforms that receive high marks from NerdWallet and other ratings companies include TD Ameritrade, Fidelity, Interactive Brokers, Merrill Edge, Vanguard, E-Trade, Ali Invest, Robinhood, Charles Schwab. All of these platforms offer $0 fees per trade for most transactions and no monthly account minimums. Even if companies have account minimums, they will often waive the minimum if you set up automatic recurring investments. Second, pick the type of investment you want to get into. There are a lot of options here, such as mutual funds and individual stocks. There are more than 7,000 mutual funds in the United States, so no shortage to choose from. There are also no shortages of individual stocks to choose from, as there are more than 5,000 companies listed on U.S. stock exchanges. However, we wouldn't recommend buying individual stocks as a beginner if you want to become a serious investor. Single stocks are more volatile than mutual funds, so they carry more risk. Mutual funds are a great way to get started with an investing portfolio. A mutual fund is a pool of money from many investors that invests the money in various securities such as stocks, bonds, and short-term debt. Each mutual fund has a stated objective which defines their investment thesis. The management team then allocates the money in the fund across the securities in that sector. Examples are small cap or large cap funds. Market capitalization is defined as the value of all outstanding shares of a corporation. Typically, the larger the market capitalization of a company, the more stable it is and the lower the volatility of the stock price, since it has likely been around longer and is more established. Small cap stocks are typically younger, higher growth stocks. Investing in small caps could lead to large growth but also come with the risk of potential large losses if the stock or the market in general doesn't perform well. The exact boundary between small and large cap stocks varies by investment platform, but a typical definition is that small cap stocks are those with market capitalization between $300 million and $2 billion. Large cap stocks are those with market capitalization greater than $10 billion. Selecting which mutual fund to invest in depends on your investing goals. If you have a longer time horizon and want to be more aggressive, choose a mutual fund with stated goals around growth that have exposure to sectors like emerging markets or small cap growth. If you have a shorter time horizon or want to be more conservative, choose mutual funds that have exposure to fixed income, cash investments, and large cap equity. If after thinking about your investing objectives and researching mutual funds, you still haven't found the right option for you, consider a default investment in a mutual fund that gives broad exposure to the U.S. stock market. For example, the Standard & Poor's 500, also known as the S&P 500, typically is considered the benchmark for the overall U.S. stock market, since it is an index that tracks the stock performance of 500 large companies listed on U.S. stock exchanges. The Dow Jones Industrial Average, or the Dow, on the other hand, is an index that tracks 30 prominent companies listed in the United States, so it provides a look at a much smaller number of companies, though they are some of the largest. Investing in an S&P 500 index fund is often seen as a great first investment, as it basically tracks the overall performance of the U.S. stock market, and they have lower expense rations given that they are passively managed funds rather than actively managed funds. Almost every investing platform has their own S&P 500 index, and there are only small differences between them. Other similar options that are highly rated as mutual funds for beginners include Schwab US Large Cap Value ETF, ticker symbol SCHV, Vanguard Total Stock Market ETF, ticker symbol VTI, Vanguard Total International Stock ETF, ticker symbol VXUS, or Vanguard Total Bond Market ETF, ticker symbol BND. These funds all search for broad exposure for their respective sectors, which creates diversification that will deliver market-performing growth, minimize risk, and do so at a very low cost to the investor. There is a lot to investing, but there are key principles that are easy to remember. Here is the summary. Get started as early as you can. Find a solid investing platform. Determine your investing goals. Choose a mutual fund that matches your investing goals and risk tolerance. If you are having difficulty choosing a mutual fund, a good default choice is an S&P 500 index or one that tracks the overall market. Make your investments automated on a routine basis, such as monthly. Note that past performance is not a guarantee of future results. We live in a very volatile time now, so it is likely that investing in the future is going to be different than investing historically, so there is no guarantee about your investing performance. Let us know what you think in the comment section below. Also, let us know if you have specific topics or questions you want us to address in future videos. Don't forget to like this video and subscribe to our channel so we can help achieve our mission of empowering people to achieve financial independence. Thank you for watching, and we'll see you next time.